Have you ever wondered how emotions can influence your investment decisions? Well, you're not alone. It's a complex interplay that often takes investors on a wild ride, much like an emotional roller coaster. Let's start with two powerful emotions that can influence our investing decisions: fear and greed. Now imagine you're on a roller coaster. The fear you feel as you're plummeting down is akin to the fear investors feel during a market downturn. This fear can trigger a panic and drive investors to sell their stocks, often at a loss. On the other hand, as the roller coaster climbs, the thrill you feel is similar to the greed that investors may experience during a bull market. This greed can lead to overconfidence, resulting in excessive risk-taking and potentially catastrophic losses. But that's not all. The emotional roller coaster doesn't stop there. We also have to contend with something called confirmation bias. This is when we selectively seek out information that confirms our existing beliefs while conveniently ignoring any evidence that contradicts them. In the context of investing, confirmation bias can make us stick to our original investment thesis, even when the market is telling us otherwise. For example, you may hold on to a stock that's consistently underperforming because you're convinced it's undervalued, ignoring the fact that its fundamentals are deteriorating. This bias can blind us to reality, leading to poor investment decisions and missed opportunities. It can make us hold on to losers for too long or sell winners too soon, all because we're wedded to our initial beliefs and unwilling to change our view in the face of new information. So as we can see, our emotions can heavily influence our decision-making process when investing. Fear, greed, and confirmation bias can steer us off course, leading us to make decisions that are not in our best financial interest. But by understanding these emotional pitfalls, we can start to navigate the market more effectively, making decisions that are driven by logic and sound judgment, rather than by the emotional roller coaster we're riding. Now that we understand the emotional roller coaster, let's see how these emotions can impact your investment portfolio. An investor's emotional state can lead to a range of common mistakes. One of the most prevalent is what we call buying high and selling low. This phrase might sound counterintuitive, but it's a trap that many investors fall into. The fear of missing out drives investors to buy when the market is soaring, and the fear of losing money pushes them to sell during market downturns. What's the result? Well, they buy at a premium and sell at a discount, resulting in financial losses. Next, we have the pitfall of holding on to losing investments. It's natural to hope for a rebound, but sometimes this hope turns into denial. Investors may overlook or ignore signs that their initial investment thesis was off the mark. They hold on to a sinking ship, hoping it will somehow float again, but in most cases, this just leads to further losses. Lastly, we have the mistake of chasing performance. Here, greed takes center stage. It's tempting to jump into hot stocks or sectors that everyone is raving about, but without a proper strategy or understanding, investors often end up buying at the peak. When the hype fades and the price drops, they're left with a poor performing investment. So what's the common thread here? Emotion. Fear, greed, hope, and denial can all lead to impulsive decisions and poor judgment. They can make us lose sight of our long-term goals and strategies. And when that happens, financial losses are often not far behind. It's clear that our emotions can lead us to make costly mistakes in the stock market. But don't worry, it's not all doom and gloom. As we'll see in the next segment, there are strategies we can use to overcome these emotional biases and make more rational and hopefully more profitable investment decisions. Stay tuned. But don't worry, there are strategies to overcome these emotional biases and make more rational investment decisions. Firstly, it's all about setting clear investment goals. Establish what you hope to achieve with your investments. Are you saving for retirement, a new house, or your child's college education? Having a clear end goal in mind can help you stay focused and disciplined, even when the market takes a dip. It's like having a compass that always points you in the right direction, no matter how stormy the seas get. Closely tied to this is having a well-defined investment strategy. This is your roadmap, detailing how you'll reach your investment goals. Will you invest in growth stocks, value stocks, or a mix of both? How much risk are you willing to take? These are questions your strategy should answer. With a solid plan, you're less likely to be swayed by the winds of emotion. Secondly, consider diversifying your portfolio. Don't put all your eggs in one basket. A well-diversified portfolio spreads your risk across various asset classes, such as stocks, bonds, real estate, and more. This way, if one sector takes a hit, your entire portfolio won't crumble. Diversification can also help temper your emotional reactions to market fluctuations. If one part of your portfolio is down, another might be up, providing balance and perspective. Lastly, practice patience and discipline. The stock market is not a get-rich-quick scheme. It's a long-term game that requires patience. Don't rush into investments out of fear of missing out or sell in a panic during a market downturn. Discipline yourself to stick to your strategy, even when your emotions are telling you otherwise. Patience and discipline are the keys to avoiding impulsive decisions based on emotions. Remember, take your time to research and analyze before making any moves. The tortoise won the race, not the hare. By implementing these strategies, we can reduce the impact of our emotions on our investment decisions. So, let's take control of our emotions and let rationality guide our investment decisions. One effective way to manage your emotions in the stock market is through mindfulness. This is a powerful tool that involves staying fully present in the moment, consciously aware of your thoughts and emotions without judgment. Mindful investing isn't about making quick, rash decisions or getting swept up in market hype. It's about making thoughtful, informed choices. Imagine you're in a bustling stock exchange. The numbers are climbing and falling, the air is filled with tension, but amidst it all, you remain calm and composed. You're not reactive. Instead, you're responsive, taking a step back to assess the situation before taking action. One way to foster mindfulness is through simple breathing exercises. When market turbulence hits, take a deep breath, hold it, then exhale slowly. This simple action can help calm your nerves, allowing you to think clearly and make rational decisions. By understanding and managing stock market psychology, we can turn our emotions into our greatest asset instead of our biggest liability.